how good is this for the average beginner trying to build long-term wealth? We'll look at risk, diversification, effort, liquidity, return potential, and one thing beginners constantly forget: time horizon. Because an investment can be S tier for money you won't need for 20 years, and a terrible choice for money you need next summer. Let's rank them. First up, not saving anything. You earn money, you spend all of it, and every month your account somehow returns to zero. This goes straight into F tier, no debate. Next up, the lottery. And I already know someone is going to say, but someone has to win. Yes, and someone also gets struck by lightning. That doesn't make standing in a field during a thunderstorm an investment strategy. The issue isn't simply high risk. With stocks, you accept risk because you own productive assets with the potential to create value. With a lottery ticket, you're buying a tiny probability of an enormous payout. That's entertainment, not investing. Buy a ticket because it's fun? Fine. Build your retirement plan around it? Please don't. F tier. Now we have Pokémon cards. And yes, some cards have become incredibly valuable. A rare card in perfect condition can absolutely increase in price. But let's be honest about what you're doing. You're trying to predict future collector demand. You need to understand sets, rarity, condition, grading, storage, and what buyers are actually willing to pay. And unlike an index fund, the card isn't generating profits. It isn't paying interest. It isn't creating cash flow. You're hoping someone in the future values it more than you paid. That doesn't mean collectibles are stupid. They can be fun. They can hold value. And if you genuinely understand the market, maybe you find opportunities. But for the average beginner building wealth, Pokemon cards go in D tier, and I say that with love. Buy them for nostalgia, not because Pikachu is your pension plan. Next, the humble savings account. This one is complicated, because saving money is obviously better than spending everything, and for an emergency fund, a savings account can be fantastic. You want stability, you want access, you do not want your emergency fund crashing 30% the week your car breaks down. But remember our rule, we're ranking long-term wealth building tools. And for money you're trying to grow over 20 or 30 years, keeping everything in cash is weak. Your money might grow slowly, but inflation can work against your purchasing power. So for long-term wealth building, D tier, better than nothing, much better than the lottery. But it is not where I want my long-term money sitting forever. Now let's talk about liquidity funds or money market style funds. These are usually low-risk funds that invest in short-term debt instruments. They're designed to be more stable than stock funds, and they can make sense for money you may need relatively soon. So if your goal is to park cash for a short period, or you want something slightly more productive than a normal savings account, liquidity funds can be useful. But as a long-term wealth building engine, not really. The expected return is usually lower than stocks because the risk is lower. That is not a flaw. That is the point. So I'm putting liquidity funds in C tier, not bad, just not built for long-term wealth. Next up, high-yield bond funds. The name sounds attractive. High yield, who doesn't want that? But there is a reason the yield is higher. High-yield bond funds usually lend to companies with weaker credit quality. That means you may get a higher interest rate, but you're also taking more credit risk. So this is not the same as a normal savings account, and it is not the same as a safe bond fund. In good times, high-yield funds can look great, but when the economy gets stressed, they can fall much more than beginners expect. So high yield funds go in C tier. They can have a place in a portfolio, but they are not the safe, boring product the name might make them sound like. Higher yield is not free money. It is compensation for higher risk. Now we have gold. The investment people suddenly become obsessed with whenever the world feels like it's ending. Gold has legitimate uses in a diversified portfolio. But let's remove the mythology. Gold does not run a business. It does not sell products. It does not generate earnings. You own gold because you believe the market will continue valuing gold. As a small diversification tool, I understand it. As your entire retirement plan, no. Gold goes in C tier. Useful in the right portfolio, but I think some people expect it to do a job it was never designed to do. And now to crypto. Oh, this comment section is about to become fun. First, putting every cryptocurrency into one category is obviously imperfect. Bitcoin is not the same thing as a random token launched 3 hours ago by someone called Crypto King 99, but we're ranking the category from the perspective of a beginner, and crypto has a problem. The upside can be enormous, but so can the volatility. This is the type of asset where people see the price go up 200% and suddenly decide risk no longer exists. then it drops and everyone remembers. Personally, I don't think a small speculative allocation automatically destroys a sensible portfolio. But if 80% of your net worth is in a token because someone on TikTok said, Carlin, this is the next Bitcoin, we need to talk. For the average beginner, crypto goes in C tier, maybe even D, depending on what you're buying. High upside, like very high uncertainty, and absolutely not the foundation I would build a beginner portfolio on. Quick pause. If this tier list is making investing feel simpler, hit the like button and subscribe. That's exactly what Growth Minded is about. Personal finance, no hype. And if you disagree with one of these rankings, good. Drop your tier list in the comments. Now let's keep going. Next up, stock trading. And to be clear, individual stock investing and stock trading are not the same thing. Buying a company because you believe in its long-term economics, that's one thing. Opening 17 charts, drawing 6 triangles, and trying to predict what the market will do before lunch. Different game. Active trading adds timing, transaction decisions, emotion, and often concentration. And the biggest problem is that beginners usually enter trading because it looks faster. Faster money, faster results, more excitement. That's exactly why I don't love it as a wealth building strategy for beginners. Can skilled traders make money? Of course. But we're ranking strategies for the average beginner. Stock trading goes in F tier. There are easier ways to make building wealth unnecessarily difficult. Now we have individual stocks, Apple, Microsoft, Tesla. Whatever company you've spent the last 3 weeks researching, the upside is obvious. Pick an exceptional company at the right price and you can outperform the broader market. The problem? You're concentrated. If you buy one company and you're wrong, you're wrong. There's nowhere to hide. You also need to understand the business, revenue, margins, debt, competition, valuation. And no, watching 3 YouTube videos called This Stock Will 10x does not count as equity research. For someone who enjoys investing and is genuinely willing to do the work, individual stocks can be interesting. But for the average beginner, B tier. Good potential, but much easier to mess up than people think. Now we have bonds and bond funds. Bonds might be the least exciting thing in this entire video, which is exactly why they deserve some respect. When you buy a bond, you're basically lending money to a government or company. In return, they pay interest. Bond funds can be useful because they can give your portfolio more stability. They usually do not have the same growth potential as stocks, but they can reduce volatility and make it easier to stay invested when the stock market gets scary. That matters, because the best investment strategy is not just the one with the highest theoretical return. It is the one you can actually stick with. For a young investor with a very long time horizon, bonds may not be the main engine of wealth. But for someone who wants lower volatility or has a shorter time horizon, bonds can be extremely useful. So bonds and bond funds go in B tier. Not exciting, but definitely useful. Now let's talk about actively managed funds. This is where a professional fund manager tries to pick investments and beat the market. And I actually think active funds deserve more respect than some index investors give them. A good active fund can absolutely be valuable. You get professional management, a clear strategy, and in some markets, active managers may have more room to find opportunities. So I'm not putting active funds in C tier. I'm putting them in A tier, but not S tier. Here's why. With a global index fund, the strategy is simple. Own the market at low cost. With an active fund, you need the manager to be good, the strategy to keep working, and the performance to be strong enough to justify the higher fees. That can happen, but it is harder to identify in advance. So active funds can be good, very good even, but for the average beginner who wants the simplest long-term foundation, global index funds still win. A tier. Now let's talk about buying your own home. This is where the internet gets annoying. One side says renting is throwing money away. The other side says your home is not an investment. Reality is more complicated. Buying a home can help you build equity, and unlike a stock certificate, you can actually live inside it. That's useful. But homes are expensive to buy and own. There are mortgage costs, maintenance, repairs, insurance, and transaction costs. Your house is also not diversified. If you own one property in one city, a large part of your wealth may depend on one local housing market. So is buying a home good? For the right person with stable finances, a realistic budget, and plans to stay long enough? Absolutely. Home ownership goes in A tier, but not S, because buying a house you cannot afford does not magically become a good investment because someone calls it property. Now let's separate buying your own home from buying property as an investment. Rental property, the appeal is obvious. You buy a property, a tenant pays rent, that income can help cover the mortgage and other costs, and over time you may build equity. You can also use leverage, meaning you control a large asset without paying the full purchase price in cash. That can make the upside powerful. But here's the part social media sometimes skips. Rental property is not passive just because someone on Instagram calls it passive income. Tenants, maintenance, vacancies, repairs, insurance, taxes, and sometimes a phone call about a broken toilet at the worst possible time. You also need much more money to get started than you do with an index fund, and buying one apartment or one house is not exactly diversified. Still, if you understand the numbers, buy carefully, and are willing to treat it like a business, rental property can be a serious wealth building tool. A tier, great potential, but definitely not as simple as pressing buy on an index fund once a month. And finally, global index funds. I don't think anyone who has watched this channel is going to be surprised. S tier. For the average beginner trying to build wealth over a long period, this is incredibly difficult to beat as a simple starting point. A broad global index fund gives you exposure to companies across markets and industries. You do not need to predict whether one company wins. You do not need to stare at charts every morning. You do not need to find the next Nvidia before everyone else. You're basically saying, I believe businesses around the world will continue trying to grow and make money over the long term. Now here's the important part, time horizon. I would not take money I absolutely need next year and throw it into a global index fund. Stocks can fall, funds can lose value, but for money with a genuinely long horizon, 10 years, 20 years, 30 years, a low-cost, broadly diversified global index fund is S tier for the average beginner. Simple, diversified, scalable, and boring. Beautifully boring. So here's the final tier list. S tier, global index funds. A tier, actively managed funds, buying your own home, rental property. B tier, individual stocks, bonds and bond funds. C tier, liquidity funds, high yield bond funds, gold, crypto. D tier, savings accounts, Pokémon cards. F tier, stock trading for the average beginner, the lottery, and saving absolutely nothing. But here's the most important thing. This tier list changes when your goal changes. A savings account is D tier for 30-year wealth building, but S tier for an emergency fund. Bonds might be B tier for a 20-year-old chasing growth, but far more important for someone who needs stability. A global index fund can be S tier for long-term money and still be the wrong place for a house deposit you need next year. There is no investment that is automatically perfect. You need to ask, what is this money for? When will I need it? And how much risk can I actually handle? Because the best investment isn't simply the one with the highest possible return. It's the one that actually fits the job your money needs to do. Now it's your turn. Which ranking do you completely disagree with? And where would you put crypto? S tier, F tier, or somewhere in the middle? Let me know in the comments. And if you want simple investing and personal finance without the hype, subscribe to Growth Minded. See you in the next one.